Hello, welcome to Brokers Alliance Monthly Summary for April of 2015. Your monthly summary of market and economic news for annuity and life professionals. I'm Jonathan Illig of Brokers Alliance. Well, April 2015 saw slight increases of less than 1% in the S&P 500, the Dow Industrial Average, and the NASDAQ Composite Indices, while the Russell 2000 Index actually declined by a bit over 2.5%. Now, our calendar year-to-date performance of these broad U.S. indices remains completely lackluster, with the S&P 500 posting a year-to-date gain of only 1.29%, the Dow barely positive at 0.1%. The NASDAQ is our star at plus 4.32% year-to-date, and the Russell 2000 Index has posted a gain of just 1.27% thus far in 2015. Now overseas, the EuroStoxx 50 index, still benefiting from direct asset purchases by the European Central Bank, has risen almost 15% for 2015, and the Hang Seng Index is benefiting from the stock mania in China right now with a year-to-date gain of over 19%. Now, despite the gains in the overseas broad indices, overall consensus amongst the financial press is that the markets have really been range-bound, meaning that they're bouncing up and down within a more or less constant range of highs and lows. In other words, a lot of activity and some volatility that ultimately results in very little net movement. To quote from Phoenix Capital Research from the article on page 8, quote, "Wall Street has tried desperately to gun the markets. Stocks have been in a rising wedge pattern since November. Thus far, Wall Street has failed to generate the desired breakout, and they are running out of time. If they cannot mount a breakout to the upside for stocks in the next 2 weeks, intense selling pressure will commence," end quote. Now, in that article, which was published on April 30th, it's titled, "Stocks Bubble Right as the Economy Rolls Over, Next Up the Bloodbath," Phoenix Capital Research has now publicly called the top. Thus, our headline for this month, which is, of course, stalled near the top. While the roller coaster analogy is sort of cliche, it really is quite illustrative in this case. When stalled near the top of a hill, or even at the top, one of two things is going to happen going forward. That car will either roll backwards, or if the mechanics can get it moving, it will go up a bit more and then it'll go down. In either event, the ultimate direction is the same over time. Now, of course, we don't know for sure how close to the top of the hill we are at. We only know we've seemed to be stalled now after a 6-year run uphill. So to complete this analogy, it's kind of as if the top of the hill is shrouded in fog. But common sense tells us, as do all the other indicators, that we got to be near the top. So to continue this analogy, in order for that car to continue to move up the hill, it must have power. And the closer to the top, the more power is required. So in the case of the financial markets, the power to move the car is the economic conditions, and frankly, they're deteriorating. April ended with the news that U.S. first quarter GDP grew by only 0.2%, and many analysts are predicting that's going to be revised even lower in the coming weeks. Now, the GDP figure is far below what the blue chip consensus of economists were predicting. As we see at this chart here, the predictions have been way, way off. Similarly, other economic indicators are predicting an economic slowdown. Construction spending in April dropped by the most since April of 2009, and the manufacturing index for April was at its lowest level since January of 2015. Nonetheless, while the employment figures are holding steady, corporate capital expenditures have been negative for 6 consecutive months now. And perhaps the biggest factor looking ahead for the financial markets is, as always in the new normal, the Federal Reserve meeting last week signaled the continued intent of the Fed to raise interest rates in the relatively near future. Now, of course, even a small increase in interest rates will have a large effect upon the markets. This is not so much because the market players think higher rates will cause the economy to contract, although this is always the ostensible reason for Wall Street to object to rate increases. In this case, it's because the big players and many retail investors with margin accounts are leveraged up to their eyeballs with money borrowed cheap to invest in assets. When we have a lot of highly leveraged players, it does not take much to bring down this house of cards. We've seen this show before, and we know how it ends. Now, I want to bring in my friend and colleague Brian Byers, founder of Advanced Retirement Planning in Atlanta, and one of the most successful guys I know. And I want to get his take on all of this. Brian, what are you telling your clients these days?
Thanks, John, and thank you to Brokers Alliance for having me this month. You know, the conversation that we're having with clients are a very serious one now. We're going back and we're talking to clients about trying to remind them of what happened in 2008, what happened in 2000, what happened in these markets when they crashed, how much pain was involved. If the same thing happened now, and they take their account and they minus it by 30 or 40%, how would that figure look? Also, looking at how much income they can derive from their accounts. How much can they get now where it's at? And then taking 30 or 40% out and saying this is where you would be. That really kind of opens their eyes up, and it reminds them of the pain that they experienced before, but they forgot. This financial tsunami is going to hit. It's just a matter of the storm's brewing. It's not a matter of if, it's a matter of when. And so it's important to sit down and have these conversations with your clients. It's important to sit down and kind of review these sort of things and look at what are their risk tolerance. Stockbrokers always tell you when the markets are going down, stay in the market. You haven't lost anything until you sold it. Just stick it out. But the reality is when markets have gained like they have, you also have not captured it until you sell it. You've got to capture the gains. Look and show your clients where they can be now. Show them the safety and the security that you can provide. That's the best part about our industry, is that it's safe, it's guaranteed. We're bringing peace of mind to these clients. So share this conversation with them. They will thank you later. John, it was great talking to you, and I look forward to seeing you in future episodes.
Thank you, Brian. Well said, sir. Well, thinking of Brian's comments, I'm compelled to quote from John Hussman's weekly letter to his investors, in this case from the last week of April. Now, John Hussman is, of course, the founder and CEO of Hussman Funds, and he has drawn a lot of criticism over the past few years over his continued and very public comments that the conditions for a crash are increasing. Thus, he's managed his fund very conservatively and frankly missed much of the gains that others have enjoyed. Nonetheless, he did predict the 08-09 recession. Well, on April 27th, Dr. Hussman wrote, and I quote, "On the basis of valuation measures best correlated with actual subsequent market returns, we can say with a strong degree of confidence that the S&P 500 would presently have to drop to the 940 level in order for investors to expect a historically normal 10-year total return of 10% annually." Now, that 940 figure for the S&P 500 would not represent some extreme catastrophic outcome. It's not even a level that would even represent undervaluation from a historical perspective. It's the level that we would associate with average, historically run-of-the-mill long-term equity returns. As we observed at the 2000 peak, if you understand values and market history, you know we're not joking. Now, the S&P 500 index ended in April with a closing value of 2,085. The 940 level mentioned by Dr. Hussman would mean a decrease of 55% in the S&P 500. Not possible? Again, we've seen this show before. In closing, remember the words of Sir John Templeton, of course, founder of the Templeton Funds, and I quote Mr. Templeton, "Bull markets are born in pessimism. They grow in skepticism, they mature in optimism, and they die in euphoria," end quote. Well, that's your monthly summary for April 2015. We'll see you again next month. Thanks for joining us.